If I told you a business made 10 lakhs in sales last month, your first instinct is probably to assume they're doing incredibly well. But that top-line number tells you absolutely nothing about whether the business is actually healthy. You don't know if they own that money free and clear, or if every single rupee of it is borrowed. To figure out what a business actually owns versus what it owes to someone else, you need a specific tool, the balance sheet. Think of it like a photograph. It doesn't track performance over a month or a year. It captures the exact financial position of a business frozen on one specific date. And every balance sheet is built on one unbreakable rule: assets equals liabilities plus equity. Assets are everything the business owns. Liabilities are what it owes outsiders. Equity is the portion that actually belongs to the owner. So looking at massive sales revenue is an illusion if you ignore the debt. You have to evaluate both sides of this financial equation to find the absolute truth about a company's health. Let's test this equation on a real-world example. We'll look at Sunrise Bakery and freeze-frame its exact financial health on March 31st. This table breaks down their finances. In the assets column, we start with what they hold: 2 lakh rupees in cash sitting in the bank, and 3 lakh rupees worth of baking equipment. We add their physical inventory, flour, sugar, packaging, worth 50,000, plus another 50,000 in unpaid tabs from catering clients. That brings our total assets to 6 lakhs. Next, we map out the debts in the liabilities column. Sunrise Bakery took out a bank loan for those ovens, leaving 2.5 lakhs still due, plus 50,000 in unpaid supplier bills. That gives the bakery a total external debt of 3 lakhs. Now for the final piece. If the bakery sold all its assets and paid off all its debts today, whatever is left over becomes the equity. 6 lakhs in assets minus 3 lakhs in liabilities leaves 3 lakhs that actually belongs to the owner. Notice how the total assets on the left perfectly match the combined liabilities and equity on the right. That is why it's called a balance sheet. The two sides always have to match. This final subtraction is the only place you find a business's true net worth. It proves exactly what the owner holds free and clear. To understand why getting this balance right is a matter of survival, we have to look at what happens when the numbers hide a structural flaw. This chart compares two different businesses, Bakery A and Bakery B. From the outside, they look identical. Both show exactly 10 lakhs in total assets. But look at the liability load underneath. Bakery A carries 2 lakhs in debt. Bakery B carries 9 lakhs. Because nearly all of Bakery B's assets are funded by borrowed money, any drop in customer traffic or an unexpected repair bill could immediately bankrupt them. They have absolutely zero margin for error. Bakery A, holding far less debt against the same assets, has the financial breathing room to survive a bad month and keep operating. This specific ratio, measuring exactly how much of a company is owned versus owed, is the very first thing any bank or investor scrutinizes before risking a single rupee of their capital. A massive pile of assets means very little if it's propped up entirely by debt. The actual chance a business survives a crisis is buried in the liability structure. Once you start viewing businesses through the lens of a balance sheet, a few persistent financial myths fall apart. First, high revenue does not guarantee a strong balance sheet. A company can bring in millions in sales and still be structurally drowning in high-interest loans. Second, looking at your bank account and seeing cash does not mean your business is generating a profit. And finally, a balance sheet will never tell you how well a business performed over the course of a year. It only shows you the resulting damage or growth frozen on a single day, which leaves an obvious gap in the story. We know Sunrise Bakery ended up with 3 lakhs in equity, but what actual business activities generated that value over the previous 12 months? While the balance sheet proves exactly what a business is worth today, figuring out how it got there requires tracking its continuous performance. And for that, you need the profit and loss statement.